Over the past 2 weeks, we have witnessed our first real global panic in the market since 2011. And Monday morning, as the market opened, we saw a significant decline in the market. The market started down 7.5%. Trading got halted at that point. And then once it restarted again, after a short time of it going back up, it started to decline for the rest of the day. I think it's important that we update people on what we're actually seeing in the market. Today, we want to go over a couple of things. Number one, why there's this global panic. Number two, what are our thoughts and predictions as we sort of head into this? And then I think what are action plans that we're going to have as we start to see this thing through, because we know it's not going to end anytime soon. Matt, what's causing really a lot of this global panic right now?
Hey, Brent, it's great to see you today. This global panic is being caused by a health crisis, right? Pretty much this coronavirus, COVID-19, it is sweeping the world, and it's causing not only a global kind of health pandemic, but also it's now starting to cause an economic crisis. We're starting to see large-scale event cancellations, South by Southwest, Coachella, events in Europe and China have been canceled for the last month or so. Airlines, Delta, American, they're starting to cancel flights. Schools, did you notice schools in Western New York and then in Seattle have been closed for the past week? The cruise industry is flatlining, as the CDC has said that Americans should avoid going on cruises. And then I don't know if you've seen the news recently about Italy, but they've effectively quarantining their whole country, which is pretty much unheard of for a democratic institution like them.
Have we ever seen in any of the economic crises that we've been in the past, have we ever seen event cancellations, flight cancellations, or things of this magnitude before?
No, we haven't seen it, mostly because we haven't seen a pandemic this bad, that's spread this fast, that's killing this many people.
And is it normal for the market to have such a substantial reaction like this?
Yeah, absolutely. The market will always react faster and more sharply than you think. All right, so if you're staying at home and you're saying, hey, this is no big deal, I'm not sick, I can still live my life, I don't know anybody with the coronavirus, that's all fine. But the stock market is pricing in the worst outcomes. And that's why we're seeing extreme volatility.
Do you think the market believes in the worst outcome is going to happen?
I mean, I'm certain that there are people who believe in it. I don't know if the market as a whole does, because, I mean, we were up today, right? We almost made back the losses from Monday. So obviously some people are becoming more bullish.
So what happened Monday that really impacted the market?
I personally think it was a little bit more having to do with oil. Russia and Saudi Arabia look like they're having a staring contest over how much oil supply they could put on the market. And the price of oil collapsed by 30%. And that led to the S&P 500 oil sector cratering by 20%.
So what else is causing this global panic, Matthew?
I think it's really those two things. You know, the virus and the oil are causing people to freak out.
Mm-hmm. So what should we expect to happen next?
So the government's already floating ideas about fiscal stimulus, which is what we need. We need the Trump administration to really fire off what I'm going to call a fiscal bazooka. All right, we need them to rain money onto the economy. So far, they're talking about free COVID-19 tests, government paid sick leave, payment to parents who have to stay home because their kids can't go to school. We're looking at payroll tax cuts and hopefully some benefits for small business owners as well.
Do you think this will be enough to get the market back to where it needs to be?
Back to the highs?
Yeah, or just back enough where we don't go into a deep recession like 08 or 09, because that's what most people are starting to wonder.
Yeah, no, this isn't going to be a deep recession like 09. I mean, there's always a potential for contagion and spillover effects. But if the government acts fast and provides that fiscal stimulus, it should give people the confidence they need to go out, spend money, and that should hold us out of a recession. A recession is just a lack of economic confidence.
Right. And so what do the S&P drawdowns look like right now?
So when we take a look at the drawdown we're currently in, that's marked by the minus 18% on the far right of the chart. We could see that actually the drawdown in 2018 was much worse. That was just happening at Christmas time, so no one remembered. And then we had multiple large drawdowns of 17% in 2011 during the Eurozone debt crisis. I'm starting to think that this looks more to me like the Eurozone debt crisis of 2011 than it does of the great financial crisis of 2008.
And how long did that last for?
The Eurozone debt crisis lasted for a good year, and people were really, really scared. And I believe the S&P 500 closed down 7% that year. So we could be looking at a negative return S&P year if this virus doesn't blow over and contain itself. But there are positive signs that are coming out of China and South Korea within the last week.
So why don't we just sell everything in the portfolio and then try and get back in when this is all over?
That's a great question, Brent. And it's not like CNBC puts up a banner that says, "Hey, it's all clear, buy stocks now." As our friend, colleague, and advisor at RPH likes to say, Joshua Winterswijk, you have to be right twice. And using some data from dimensional fund advisors, what we can see here is if you just leave your money alone in the stock market, you're going to get 9.96%. But if you take your money out and you miss the best 15 trading days of the year, you only get 6.56%. So it drops your return by over 3 percentage points. And what we know about market volatility is the best days in the stock market are clustered around the worst. And you can see that today when on Monday the S&P 500 was down 8%, and today it was up 5%. Right? So we're already making back those losses.
So what you're saying is it's pretty much impossible to time the market, to know when to get out, to know when to get back in. Because if you do get out, you don't know when to get back in. And if you do jump back in, it's going to be too late, or you're going to miss that one day. And if you miss that day, then you've already missed out.
Yeah, absolutely. If you pulled out yesterday, you missed today.
So what does the historical data say that what's to come right now?
Yeah, so great question. And we actually are looking at a data set that goes all the way back to 1926. So it's almost 20 years old. And what we're measuring is market declines and the returns in the years following. So following a 10%, 15%, and 20% decline. We'll look at 20% because that's what we're getting close to, and we might have a shot at hitting that. But following a 20% market decline, the following year, stocks go up by 14.2%. 3 years later, the average return is 11% a year, and a 5-year average of 11.76%. That beats the average rate of return of 9.6%. So right now is a great time to be forecasting higher stock prices within the next year, 3 years, and 5 years.
Which means that the best, I think, is still yet to come. We're in sort of that trough or that bad phase. but there's still a lot of positive news that will come in the next year to two.
Yeah, absolutely. I would expect that.
And so what do you think about people who right now are worried about their money? They're not so worried about the actual virus necessarily. They don't think it's a big deal. So I think the society's kind of split. But what do you think that they should do with their money at this point?
Yeah, so we've laid out an action plan that people could take, and it's pretty simple. One, if you have cash in excess of your emergency fund, we just showed on the previous slide that historically it's paid to buy stocks when the market drops. You could also increase your 401k contributions or make your IRA contributions now. That's a great way to do it. You could do a dollar cost averaging strategy, which is, let's say you want to invest $100,000, maybe you invest $10,000 a week for the next 10 weeks. And then finally, the good old fashioned rebalance the portfolio, right? Bonds have been on a big run. So you sell the bonds and then stocks are down. So then you buy stocks and you're pretty much forcing yourself into the, I'm going to sell high and buy low mentality.
Yeah, and I think this is why, like last year, we saw the market really increase. We did rebalance a lot of clients out of stocks and more into bonds. And we did give a lot of clients the option, but it's pretty hard for clients to say, well, let's get out of the stock market when it's ripping. But for those who just said, yes, let's rebalance, it's a good lesson that you just have to follow the data. And the data says, when you're about 5% from that target allocation, pull it back down. And we're going to do the same back up to stocks as the market is continuing to decline to make sure it's emotional right now too, right, Matthew? Like people aren't going to want to go into higher percentage in stocks, but if we do, we know based on your last couple of slides that the best is still yet to come in the next couple of years.
Yeah, I agree. Now's a great time. Trust the process and, don't panic. Don't make a move you're gonna regret. Everyone who sold in 08 was really kicking themselves by 2012.
Yeah, so I think we're really excited about what we get to do during these times. It's a fun time in the market. It's not so fun to check balances, so don't look at them, I don't think, every day. Kind of just don't pay attention, but just know we're on top of it and there's things to do and we're working on. And Matthew, I thank you for these slides because it really tells us some good insight.
Oh, thank you. And thank you everyone for tuning in today and watching our second ever YouTube.
Thank you.
Bye.